Gold didn't just surge overnight. Something inside the rate complex slipped, and the market is pretending it was just another headline, because admitting the real driver changes what comes next. The price is loud, sure, but the spread behavior and the currency tape are louder, and that's where the pressure starts. What happened wasn't a random emotional flinch. It was a fast repricing of policy credibility. And that kind of repricing doesn't stay neatly contained inside bonds. It bleeds into the dollar, into volatility, into the hedging books that are forced to respond. And then, almost like a delayed fuse, it detonates in gold. And if you're only watching the gold print, you're already late to the mechanism. Here's the conflict you need to understand right away. There's a whole ecosystem that benefits when you believe this move is temporary, chaotic, and untradeable. Because if you accept it as structural, then you start asking structural questions about who's trapped, what has to rebalance, and what levels become magnets. And the next detail is what flips the whole setup. The hidden detail isn't rates are going down or rates are going up. The hidden detail is that the market is repricing whether rates will be allowed to be what they need to be. That's a different animal. That's why the reaction looked like a safe haven stampede even while the yield tape was whipsawing. And once you see that, you'll understand why gold can make an overnight high that looks absurd on a chart and still be early in a sequence that lasts weeks. But that's not the part that matters. The part that matters is the order of events. Because order tells you causality, and causality tells you what to watch next week when the easy narratives fade and the desks go back to managing risk. In the overnight move, the first crack shows up where you'd expect. The dollar loses footing. Risk sentiment wobbles, and suddenly the non-yielding asset that everyone claims they only buy on dips becomes the only thing they're willing to chase in size. Gold punches into fresh air near the mid-4500s and spikes through the psychological line everyone now has printed on their screens, $4,600. Silver doesn't politely follow. It behaves like a compressed spring, ripping far harder, because that's what happens when a market with thinner depth and more violent positioning gets a real catalyst. And when gold and silver move together like that, it's rarely because people got excited. It's because portfolios are repositioning around a regime shift, even if the headlines are pretending it's a one-day story. And that's where the real pressure starts. Let's translate this into mechanics, because the audience that lives through metal cycles knows the truth. The emotion is usually just the wrapper. The math is inside. Gold reacts to rate bets through three immediate channels. One, real yields, because gold competes with the real return on cash and bonds, not the nominal headline numbers. Two, the dollar, because gold is priced globally in dollars, and a weaker dollar mechanically lifts the price for global buyers while signaling stress inside the reserve currency itself. Three, hedging demand, because when policy credibility becomes uncertain, the variance of outcomes widens, and people don't hedge with hope. They hedge with instruments that don't depend on a single institution doing the right thing on schedule. And here's the punchline. You can get a gold surge even if yields aren't cleanly collapsing, as long as the market thinks the policy path is becoming politically constrained or rhetorically cornered. That's not a conspiracy story, it's incentives and risk management. If the perceived independence of the central bank is questioned, then the distribution of future inflation, future currency stability, and future policy reaction widens. Wider distribution means more convexity demand. Convexity demand means more appetite for assets that protect you when confidence breaks. Gold sits right there, but that's not the part that matters. The next detail is what makes this move sticky. The market structure doesn't need everyone to become a gold bug. It only needs a subset of participants to become forced buyers at the same time. Liquidity thins. That's how overnight shocks become multi-week trends. Think about what happens on a desk when rate expectations shift rapidly. You're not just changing your mind. You're recalibrating VAR, you're rehedging duration exposure, you're adjusting FX hedges because your base currency assumptions just shifted. You're dealing with the fact that your equity book is suddenly more sensitive to rates and dollar moves than it was yesterday. And all of that happens while liquidity providers widen spreads and pull size, because nobody wants to be the hero catching a falling knife in a credibility event. Liquidity thins, spreads widen, and price discovery moves in jumps, not steps. And that's why gold can print a record and still have more fuel. The move itself forces risk managers to do more of the same. Reflexivity, not romance. Now, the mainstream explanation you'll hear is some variation of gold rose on safe haven demand. That's a label, not an explanation. Safe haven demand can be a tiny flow that gets amplified by positioning, or it can be a deep structural reallocation that rewrites a whole quarter. Your job is to figure out which one this is. So you don't need a single magical indicator. You need a proof stack, 5 layers minimum. Because one layer can be faked by a headline. 5 layers are harder to fake. First layer, the currency tape. If the dollar weakens into the shock, it's telling you global holders are discounting US. Policy stability or growth advantage. Second layer, the volatility bid. When vol rises while gold rises, that's not risk on. That's hedging demand, and it tends to persist. Third layer, cross-metal confirmation. If silver, platinum, and palladium join the move, it's telling you it's not just a single asset story. It's a broad repricing of monetary metals and scarcity assets. Fourth layer, term structure and spreads. When nearby contracts behave differently than deferred months, it's a signal about immediacy, about demand for exposure now versus later, and about financing and inventory dynamics. Fifth layer, on-the-ground symptoms, availability, premiums, and institutional behavior, like whether funds are adding exposure through vehicles that can absorb size without touching bars directly. And once you have that stack, you can decide if you're looking at a one-day spike or the early chapter of a regime. But that's not the part that matters. The part that matters is the hidden detail again. Credibility risk changes the rules of how markets interpret data. In a normal regime, a hot inflation print might be bad for gold, because it implies tighter policy and higher real yields. In a credibility-stressed regime, that same hot print can be good for gold, because it implies the institution will be pressured to look through inflation, or that the political cycle will dominate the policy cycle. Same data, different reaction function. And when the reaction function changes, models break. When models break, positioning gets sloppy. When positioning gets sloppy, squeezes happen. And if this one level breaks, the math changes. Let's talk levels, because levels are how you turn a story into a plan without pretending you can predict every tick. When gold spikes into the $4,600 area and prints new highs, the first thing to watch is whether it can hold above the prior breakout zone on any pullback. You don't need to obsess over the exact top. Tops are messy. What matters is whether the market treats $4,500-ish as a buy zone instead of a trap door, because $4,500 is not just a number. It's where psychology, option strikes, and risk manager thresholds tend to cluster. If gold dips and then reclaims that zone quickly, it tells you dips are being bought by participants who care about exposure, not about perfect entry. If it slices through $40,500 and can't get back above it, that's your first warning that the move was too fast and the market is flushing leverage. But even then, the story might not be dead. A flush can be part of the trend. This is where amateurs get emotionally manipulated. They see a violent red candle and assume it's over. Pros see a violent red candle and ask, did the thesis break or did leverage get cleaned out? Two different questions, two different outcomes, and the next detail is what separates them. Confirmation comes from behavior after the flush, not from the flush itself. Now, let yes make the rate bets rapidly shift part concrete without turning this into an academic lecture. The market prices the Fed path through instruments like Fed funds futures and SOFR futures. When probabilities shift, even modestly, the front end reprices, the curve changes shape, and the dollar reacts. But in this specific kind of shock, the narrative isn't the Fed will cut because growth is collapsing. The narrative is the Fed may be pressured to cut or constrained in its reaction, and that changes the risk premium on dollar assets. When that premium rises, people diversify, even if they don't announce it on television. They do it quietly, through rebalancing, through incremental allocations, through the kinds of trades that don't need permission. That is why you can see gold surge, even if the 10-year yield is not falling in a straight line. Because it's not just about yields, it's about trust in the anchor. And when the anchor wobbles, gold stops behaving like a sleepy commodity and starts behaving like an alternative monetary asset with a volatility engine attached. But that's not the part that matters. The part that matters is how this interacts with market structure and metals, because metals aren't pure macro instruments. They clear through futures, forwards, physical markets, financing, and inventories. When you hear paper versus physical, don't turn your brain off. You don't need an extreme narrative to understand the tension. Futures markets can express huge notional exposure with relatively small margin. Physical markets require actual metal, actual logistics, actual settlement. When a shock hits and demand for now exposure rises, you can get stress in the nearby structure, even if the world has plenty of gold in total. That's why deliverable versus non-deliverable, or available now versus available later, matters. Gold is abundant in the abstract, but not all gold is for sale at any price on any day. And not all gold is in the right form, in the right place, under the right financing conditions. Logistics, refining capacity, and vault constraints are slow variables. Price is a fast variable. When fast variables collide with slow variables, you get spikes. And that's exactly when spreads start telling the truth faster than headlines do. You'll see it in how the front month behaves versus the back months. You'll see it in how financing costs and lease dynamics become relevant again. You'll see it in how dealers widen bid-ask and retail inventory becomes patchy. None of that needs to be a grand plot. It's just what happens when everyone wants the same insurance at the same time. And if you're skeptical of the whole institutional behavior angle, good. Skepticism is healthy. So let's keep it grounded. Institutions don't need to believe in gold spiritually. They need to manage risks that are hard to hedge with conventional assets. If you're a global allocator and you see rising political pressure around monetary policy, you don't wait for a committee to approve a worldview. You shave exposure where the tail risks are growing and add exposure where the tail risks are hedged. Gold is a classic tail hedge for currency debasement narratives, for geopolitical escalation narratives, and for policy credibility narratives. And when those narratives overlap, the flow doesn't come in drips, it comes in waves. But that's not the part that matters. The next detail is the calendar, because calendars are catalysts even when nobody wants to admit it. Right now, you're in a window where macro data and policy expectations can whipsaw positioning fast. CPI and related inflation data become landmines because they can flip the market. S interpretation of what the Fed should do and what the Fed can do. A single print can shift the probabilities on rate moves and reshape the curve, which then reshapes the dollar. At the same time, liquidity is not uniform. Early year positioning adjustments are real, funds rebalance, risk limits reset, new allocations go to work. And in the metal space specifically, late month options. Windows and futures positioning can add fuel because dealer hedging is mechanical. Here's the simplest version of the gamma story with no mysticism. When a lot of call options sit near key strikes and the underlying starts moving up into those strikes, dealers who are short those calls hedge by buying the underlying as it rises. That buying pushes price higher, which increases the option's delta, which forces more hedging. It's a feedback loop. You don't need to know the Greek symbols to understand the behavior. Price rises, hedgers buy, price rises more. And the moment you combine that with thin liquidity and a credibility catalyst, you get the kind of vertical move that makes people feel like they missed it, which is exactly when they make their worst decisions. Because if this one level breaks, the math changes. The psychology trap is always the same. Chase the top. Because you fear missing out, then panic sell the first violent pullback because you fear being wrong. That's how volatility harvests retail. So here's the shield. You separate trend signal from noise. The trend signal is the ability to hold reclaimed levels and build higher lows after the shock. The noise is the intraday violence and the stop runs that happen because liquidity is thin and leverage is being cleaned out. If the thesis is credibility risk plus hedging demand plus structural flows, then you should expect violent whipsaws even if the thesis is correct. In fact, the more correct it is, the more violent it can be because more participants are fighting over limited liquidity. Your job is not to predict the wiggles. Your job is to recognize the regime and avoid being emotionally front-run. Now let's build the proof stack more explicitly, because trust comes from mechanisms and evidence, not from vibes. Proof point 1, gold didn't just rise. It made fresh record highs in a tight time window tied to policy credibility headlines and geopolitical stress. That timing matters because it connects the move to macro catalysts, not random flows. Proof point 2, silver didn't lag quietly. It surged aggressively, which is consistent with a broad repricing of monetary precious metals rather than a single asset quirk. Proof point 3, the dollar weakened into the event, which is what you already expect when markets begin to discount institutional stability or price and more political influence over policy. Proof point 4, bond yields whipsawed rather than trending smoothly, which is what credibility events look like. Uncertainty rises, not just rates down. And proof point 5, the narrative shifted quickly to a debasement trade framing and market commentary, which, agree or disagree, tells you how participants are interpreting the risk regime. Proof point 6, and this is subtle, when volatility rises alongside gold, the market is not simply optimistic. It's paying for protection. And protection demand is sticky, because it's driven by mandates, not by moods. And that's where the real pressure starts. But you also need counterpoints, because a credible plan always includes how it can fail. Here are the clean ways this breaks. 1, the credibility shock cools fast. Clarity returns. The institution reasserts independence convincingly, and the market's uncertainty premium collapses. In that case, gold can still be high, but the urgency flow fades, and you'll see it in weaker follow-through on up days and sharper sell-offs on down days. 2, real yields rise meaningfully because inflation cools while growth holds, or because the market suddenly believes policy will stay tight without constraint. Rising real yields are a headwind for gold, especially after a vertical run. 3, the dollar snaps back hard. Maybe because global risk worsens in a way that drives dollar demand, or because you see relative growth looks better. A stronger dollar can cap gold even if the longer-term thesis remains intact. 4, positioning becomes too crowded. When everyone is leaning the same way, the market doesn't need bad news to correct. It only needs less good news. 5, physical financing conditions ease, and the front-end stress and metal structure relaxes, removing one layer of the squeeze narrative. None of those are doom. They're just reminders that markets breathe, and you need to know what would invalidate the aggressive version of the story so you don't become a hostage to your own bias. Now, the most useful thing for the next week or two is a 2-scenario roadmap. Not because you can control outcomes, but because you can control your response. Scenario 1 is the controlled pullback and retest. In that scenario, gold cools off from the highs, maybe dips toward the $4,500 zone, maybe even wicks lower into the mid-4,400s, and then stabilizes. The tells are simple. Sell-offs get bought intraday, closes improve, and the market stops making lower lows. In that scenario, the move is digesting gains, flushing weak hands, and setting up a base for the next leg. The best confirmation is not a perfect V-bounce. It's a choppy stabilization that refuses to break key levels despite scary headlines and noisy data. Scenario 2 is the continuation squeeze. In that scenario, gold doesn't give you the comfortable dip. It consolidates shallow, liquidity stays thin, and then it rips again, potentially gapping on a data print or an escalation headline. The tells, there are also simple. Shallow pullbacks, strong closes, and broad participation from silver and related metals. In a squeeze scenario, the market punishes hesitation because the fuel is mechanical, hedging and forced buying, not patient value accumulation. The risk is gap risk. You wake up and the market is already higher, or you blink and it's already lower. That's why risk management matters more than conviction. Because if this one level breaks, the math changes. So what levels matter in a practical sense? Start with $4,600 as the psychological and recent peak zone. If the market can accept above it, it signals a new regime of price discovery because there's no recent overhead supply. Then watch $4,500 as the first major decision zone. Hold and reclaim behavior there tells you dip buyers are still active. Below that, the mid-4,400s becomes the next area where you'd expect bigger players to show interest if the macro thesis remains intact, because that's where a lot of the breakout acceleration began. It means the specific squeeze credibility impulse may be fading, and the market may need a longer consolidation. That's your invalidation lens. Not price went down, but price broke key zones and behavior changed. And behavior is everything. Does the market sell off on bad news and rebound? Or does it sell off and keep bleeding even when the news flow quiets? That's the difference between noise and regime shift. Now, let's zoom out one notch without drifting into a slow history lesson. Gold isn't rising in isolation. It's rising in a world where geopolitical stress can spike fast, where reserve currency confidence is being debated more openly, and where the policy narrative is no longer just economics, it's politics, credibility, and institutional trust. In that environment, you should expect metals to trade like a live wire. That means two things at once can be true. The long-term bid can be real, and the short-term volatility can be savage. If you're the kind of viewer who wants to be right, you'll get hurt. If you're the kind of viewer who wants to manage risk, you'll survive long enough to benefit if the thesis plays out. T. That's the psychology shield again. And don't let the market turn your identity into a position. Use levels, use scenarios, accept that even correct theses whip around, and don't confuse a fast pullback with a broken story unless the mechanics stop confirming. So what should you watch next? Concretely, this week and into the next couple of weeks. Watch how gold behaves around those key zones after the next major data prints. Because data is where narrative meets positioning. Watch the dollar. If gold rises while the dollar strengthens, that's an even louder stress signal, because it suggests the demand is not just FX translation, it's structural hedging. Watch silver's participation. If silver keeps confirming, it adds weight to the idea that this is a regime repricing rather than a one-off flight. Watch volatility and the shape of risk. If all stays bid, IT means the market is paying for protection. And that tends to keep a floor under gold dips because hedgers prefer to add on weakness. And watch the language from institutions, not the speeches for the cameras, but the subtle shifts. What gets emphasized? What gets downplayed? What becomes transitory again? Because the real market doesn't trade what they say. It trades what they are forced to do. And that's where the real pressure starts. Here's the final piece most people miss. When gold makes a record on a credibility catalyst, the next chapter is rarely a straight line. It's a battle over narrative. One side wants you to believe the move was irrational, so you ignore it. The other side doesn't need you to believe anything, just needs the mechanics to keep forcing rehedging and diversification. That's why you'll see sharp reversals designed to break confidence. That's why you'll see fake-outs around round numbers. That's why you'll see the market punish anyone who uses tight stops in a volatility regime. Volatility is not just a feature, it's a tool. It shakes out the people who can't hold a plan. So if you take one thing from this, build a plan that can survive the shakes. Identify the levels that matter. Decide which scenario you're in based on behavior, not on feelings. And keep your attention on the hidden detail, credibility, and reaction function, not on the daily noise machine. Because once the market starts pricing the idea that policy is constrained, gold doesn't need perfect conditions to stay elevated. It only needs uncertainty to remain higher than the models assumed. And right now, that uncertainty just got repriced in one night. If you're still here, you're already doing what most people won't. You're tracking mechanics instead of chasing narratives. Stick with that. Keep a simple checklist. Respect volatility. And when the next everything is fine headline shows up right as the tape is screaming the opposite, you'll know exactly which one to trust.